When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement, the show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about inflation, rates and risk, why retirement just got a bit harder. We'll also answer listener questions, and finally, what the first meeting with Premier Retirement actually looks like and why you shouldn't be nervous. My name is Jeff Shea. As always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program. It's Jeff Vogan on Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
I'm doing awesome. How are you doing?
I'm doing fantastic. Thank you. And of course, we're always grateful for the people here of the greater Tucson area for joining us. We hope you're having a great weekend as well, too. If you feel like retirement just got harder, I don't think that you're imagining it. Inflation is sticking around. Interest rates aren't coming down and the market feels strong, but it is also fragile. So, Jeff, today I wanted to break down why this current environment could quietly derail your retirement and what smart investors are doing about it. So, Jeff, let's start here. Everyone thought inflation was cooling off, and now we're hearing that it actually might be going higher again, 3.5% on its way to 4%. What is really happening here, Jeff? I thought it was going down.
Well, I think you can just blame everything on gas. I mean, the oil prices have basically doubled in the last few months just because of the war. And gas is probably the biggest inflation maker or causer. And if you look at the war in Iraq, which some people still kind of wonder if it was really necessary or not, but it is what it is. And, you know, if it is indeed to protect us from nuclear threats, I get it, but there's a cost and there's a price to pay. And even though Trump says he's not for war, I think he's America first type person. I believe he still wants that and probably doing the right thing. But even he mentioned it and other people mentioned it. There's a cost to some of these things. Sometimes protection costs us a little bit more. Probably doesn't cost us as much as some of the other policies that we have that don't have to do with war and oil. But bottom line is government, I don't know, they're always making decisions that affect us one way or the other. The mandate was to get inflation down below 2%. It never even got there. Then they got pretty happy if it started with a 2 and it wasn't a 3 something. And now we're creeping up past 3 and, like you said, probably hitting to 4. There's still a lot of money printing going on. If you think about it, it's not money printing as in the printing presses aren't going, but they're still playing with the monetary system and they're still bailing out banks and not making them really own up to their own debt, even old debts that have never been paid back. Some of the taxpayer money that's gone to fund banks' stupid decisions has just gone to be put back into play in the banks. Does that make the world a better place? Well, it makes the bank stronger. Maybe it does make the world a better place, but it certainly doesn't help inflation. I think the only thing that'll help inflation is a good recession. So now we have to decide, do we want a recession that's going to result in deflation or at least a reset in pricing and things that seem a little bit more realistic and something we can handle, or do we want to continue to make new highs in the stock market and deal with some inflation? So it's kind of a catch-22. The only way to really tame the market, the inflation in itself may tame the market just because inflation will eat up gains, but people are so used to overpaying for stock and buying investments that are at outrageously high historical values compared to the norm. Who knows how long this can be? I mean, is it QE to infinity and beyond or what? I had a lady tell me that. I said, oh, no, it's going to be QE to infinity. They already found out it works. Why would they change it? And she might be right. She's all in the market. She can't afford to lose any money. But man, she just has a conviction like nobody I've ever met. And she might be onto something. It was a recent visit I had a few weeks ago. I still like to look at fundamentals in the market. We see the breadth of the market very thin. I mean, you got 6 or 7 stocks that are carrying the weight of the entire index some days. When we make new highs and you got out of 500 stocks in the S&P, the gains of just 3 or 4 of them are balanced by the losses or the entire rest of the 495 or 497 stocks in the S&P 500. So there's a lot of things to really be concerned about. Again, inflation typically happens when there's a lot of economic good things, but they get a little bit overdone. And typically that's when we have to have these little setbacks, sell-offs in the market. The only way to really curb it is probably interest rate increases to try to slow the market down and put the brakes on, but nobody wants that, especially Trump. He loves to tell us how many times the market's made a new high. And every time the market's ever crashed, it's after a new high, by the way. So we still could have a crash. Just because it's making new highs doesn't mean it's going to keep making new highs. There's always a time when the market's going to make new highs, and there's always a time the market's going to correct. We've just had a better than 10% correction just in the last few months. And then it just zoomed back as soon as there was some rumor that the war in Iraq is over and that the Strait of Hormuz is open, and things that we found out aren't necessarily true, but somehow it gave the market enough confidence to go back into the stratosphere, into valuations. Now, we're not unhappy with that from a standpoint of investing. Our indexed annuities, our MERPs, everything goes up, even though they're principal protected, which we really love. And our managed investments are typically, when the market goes up 1 or 2%, we go up even better than that when the market's doing well, because we're being really careful about picking stocks. But we're also interested in jumping on the train when it's moving forward as fast as it is. But we have to be very nimble when we manage money to jump off at the right times and not be derailed with the train. So I think that there's a lot of worry that I have for especially the people that are do-it-yourselfers or that can't really afford to wait out a bad market, because I think just based on what I'm seeing, things like that will happen. There is a saying that go away in May, the market typically takes a pause, mostly just due to a lot of vacations and things like that, where investors don't want to really watch their money every day, and they want to take some time off during the summertime. And Wall Street kind of slows down in general during the months of May through November. If you look at history, November through May is typically the best upside in the market, and May is kind of those flat times. And some people are thinking that this might be one of those Mays where you want to walk away, because the summertime is probably a really good time for there to be some sell-offs or some people taking profits, maybe setting aside a little bit of what we've just received in good news and good market performance over the last month or so, and basically take that money and put it on the shelf, take those profits, cruise through the summer with a little bit more peace of mind. If that happens, and if there's a little bit more talk about inflation, if the Fed decides they're not going to lower interest rates, which everybody's hoping, and have probably already priced into the market, then there might be that sell-off that I've been expecting, a more steep sell-off than the one that happened in the first of the year through about the end of March or so. April ended up being a good month, but let's see what May brings. You know, we've had a few good days so far to start the month, had a few new highs to start the month. Again, we have really thin breadth. We're really not sure. Oil's kind of in limbo right now, not sure whether it's going to go up or down. It's still high. Gas is probably going to be high for a long time, just because of the fact that anybody buying oil right now has got to process it, and it's got to get to the pump over the next several months, not by next weekend. So, you know, we're probably going to see some inflationary pressures for quite a while. It looks like some of the economic numbers seem to be doing better. Surprisingly, we're seeing earnings season come in, and typically companies that report earnings for the first quarter are going to always estimate low so they can beat their earnings estimates and come in with a good market day. But smart investors are selling into that and probably taking some of the profits when those earnings come up. But the biggest thing is the guidance. So many companies are still telling the market that they expect continued robust gains and exponential growth even through the next few years. But if we talk about AI and storage and energy and all those things that are going to make this AI world work, it's true that it's going to grow and it's going to need more power, going to need more energy, going to need more storage, going to need more processing units, all that kind of thing. But it seems like some companies that have gone up thousands of percent, and I refrain from naming names because somebody will take it as a recommendation, buy the stock and it'll go down. But some stocks are going hundreds of percent or thousands of percent this year that are in certain sectors that believe they'll be affected by AI. What, don't you think if a stock can grow by that much, there's going to be some competition? Some of the competitors that also do chips, memory, and other things are going to get into the business, or that just because there's a certain market for memory, each company is expecting to get the 100% of that market share growth. I don't think that's realistic. And I think there's going to come a time when, just like in the dot-com bubble, when there was a burst bubble and the dot-coms became the dot-bombs, we're going to have an AI sell-off eventually when we find out that there's only 7 out of the 700 companies that are really going to make it work. And some of those are probably already these big, huge companies that we've already invested in and already know that are approaching trillions of dollars in market cap, or at least the hundreds of billions of dollars. The huge MAG companies are probably going to get the lion's share of that and probably buy up some of the smaller companies and merge with them, if nothing else. So it may end up coming down to, being a good stock picker for those early players. But I think long-term, people are going to have to be very careful, kind of see how this rides out. But as there's a shakeout in AI like there was in the dot-coms, where only a few companies emerge, and that sell-off is still going to take the market down. It's probably going to be the catalyst for the big market sell-off that is due. that Warren Buffett thinks is going to happen. That's why he has over 30% of his assets in Berkshire Hathaway in cash. We've got Ray Dalio doing the same thing. He's the biggest hedge fund manager on the planet. We've still got Druckenmiller. He used to be George Soros' guy, and he's doing his own thing now with billions of his own dollars. He's making some changes. He's actually I read he's starting to sell off some of his AI holdings and invest in different things that are in different sectors than, say, the chip, memory, and other sectors, but those things that might support it maybe more in the energy market, especially with energy the way it is. So some of the smart money is showing their hands, and they are called smart money because they know things that we don't know. I spend a lot of money on information, but I still don't know what they know because they have a lot more ability to spend and dig into and do research, and they just know the right people and the right stuff. Can't call that insider trading, but it is what it is. They have information that nobody else has, and they're able to make big financial decisions. So rather than try to rub shoulders with the same people and have dinner with Elon Musk to find out what he's doing, I just do with the investors that do those things with Elon Musk and those high-powered high rollers that make the world move and shake, do what they're doing. And I see a lot more caution lately, and those are the things that make me want to be a lot more vigilant in the market, especially as we see inflation, which could also be another catalyst for a market sell-off. Not just the overvaluation and things that I've been talking about, but just watching what things are doing. I would certainly think that there needs to be a little bit of caution. The worst thing about inflation is if people are super conservative and interest rates on their investments aren't as high as inflation. And right now, you can still get a CD in line with inflation. We can still get annuities in line with inflation and maybe even a little bit better. Index annuities, as long as the market does well, beats inflation. So there's plenty of ways to continue to stay up with inflation and beat inflation, including good income products. But the typical person that's invested in the stock market who thinks, yeah, I'm really keeping up with inflation. If inflation stays intact the way it is and stays at that 4% level or even starts creeping up to 5% due to the effects of gas pricing or just the monetary policy of printing money instead of tightening tightens the economy. Everybody in the White House wants to have the economy flourish when they're in there so they can take credit for it. So they actually create inflationary pressures, but inflation does end up causing a market correction. And when your money goes backwards 20 or 30% and there's still inflation, you're going to probably wish you'd have taken some of those profits off the table and locked them into those interest-bearing accounts, which are still, at this point, able to lock in returns higher than inflation and probably higher than it'll be again. I hope, and I don't think that it will happen where we see 9 or 10% inflation, but I mean, it's not out of the question. And if it does start creeping up that way, I hope the Fed's a little bit more proactive than Yellen and Powell were back when they were saying, oh, wow, we didn't realize it was going to be this bad. Oh my gosh, we should have got a jump on it. And they just made excuses for basically being reactionary late rather than doing some preventative maintenance by dealing with the monetary tightening or loosening of the supply of money. Again, there's just a lot of things. We have to just watch what's going on. We can't be in control of what they do. We can only be in control of what we do, and we have to react to those things. And that's probably why when you're climbing the mountain of retirement or getting off that mountain of retirement, you ought to have a good Sherpa that's been up and down that mountain a few times and knows how to react when these things happen. But if you're climbing that retirement mountain and getting off the first time, this might be a scary time to be at the peak of Mount Everest when you got to get off safely because there might be some trouble coming down the mountain. In other words, I use that analogy if you haven't heard it before. It's when you climb the mountain, that's just acquiring assets so you can retire. When you finally get to the top, it's a long climb to Mount Everest. And I use that example because it's the biggest mountain. It's one of the biggest tasks that we strive to do is get enough savings and get to that point where we can retire and enjoy the second half of our life on our terms without worry, without big corrections or things that we can't control, ruining or derailing our retirement or our lifestyle, where we have to always be in reactionary mode. We want to be in control mode. So again, if you haven't been up and down that mountain before, and most people haven't, they've only done retirement one time, you got to be walking that mountain with somebody that's done it before. And that's really where advisors like us come in, is we've helped people up and down that mountain for years. And we've seen these inflationary times before. We've seen market corrections before. We know how to protect against those market corrections so that regardless of what happens, you're going to be okay and that your financial house is going to continue to stay in order because you have a good foundation, strong walls, and a ceiling that's not going to blow off every time the market has a correction.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa, and we're talking about inflation, rates, risk, and the market, why retirement just got harder. Again, our phone number, 520-780-9059. If you'd like to come in and sit down and talk with Jeff and have a casual conversation about your journey towards a confident retirement, there is absolutely no cost and no obligation for that. Once again, 520 888-780-9059. And of course, we're also online at primrat.com. Jeff, the market looks strong, but we keep hearing that it's being carried by a few big companies. Why is this dangerous? In other words, a narrow rally risk.
Well, I mean, yeah, it's been that way for the last few years. It's been semiconductors and a lot of this AI-related stocks. And for a while, it was the Mag 7. The Mag 7, that's a Magnificent 7, the Apple, the Microsoft, Google, and Amazon, those big ones, haven't really performed that well. If you look at the last 6 months, they've been relatively flat, really haven't done what they've done in the past. And we've had a lot of these up-and-comer AI stocks and energy stocks that have kind of been pulling the weight. And it kind of rotates. Smart money just seems to kind of grab onto a certain sector and run it up until it's out of gas, and then they move to another sector and run it up until it's out of gas. So, if you're not able to watch those stocks in those sectors where the money's going and be nimble and be able to make those changes as things change, then you got to just like hold your breath and maybe just ride the market indexes because it's just a few stocks that are driving it. That might be your best bet. However, if there is a sell-off and money decides to start going off more into bonds, which we've seen lately, we've seen institutions increase their holdings in bonds and safe money, comparatively safe, even though bonds can go down, especially when interest rates go up, and they might have to go up if inflation continues to be problematic. But we're still seeing a lot of hedging take place, a lot of people going to cash, not even bonds, but cash. And that makes me worried that there might be a more broad sell-off. And if there's other stocks that are already weak and there's only a few that are holding it up, if there's a sell-off or somebody wants to start taking profits in 7 or 8 stocks that have been the bulk of the growth in the last few months or few years, then that's going to just tank the whole market. And if you do have index-related assets, or if you have a broad-based portfolio of different stocks, bonds, mutual funds, things like that, you could see a sell-off hurting the entire portfolio. So that's why we preach asset protection first, principal protected assets to generate income so that when those things happen, you don't have to rely on income from assets that are being corrected by the market or crashing in the market. We want to make sure that that's your long-term money, that you can wait those correction periods out. You can ride the roller coaster of the market while you still get a paycheck that pays your bills every month during your retirement, not just for the next year or two, but for the next few decades.
Jeff, people have been waiting for rate cuts for years now. Kevin Warsh is the new Fed chair, but it doesn't look like that's going to happen anytime soon. Is that your take on this?
Well, I mean, with the inflationary pressures, it'd be hard to justify, even though I think Trump wants interest rates to go low, so it stimulates the economy and helps people be able to buy real estate and different things that are kind of on hold right now. But with monetary easing, making people have easy access to money at a cheaper rate also causes more inflation. So they really can't do that. I just don't see that as being a feasible solution to this deal with inflation. And of course, inflation is being driven more by the oil and the crisis in the Middle East than it is by just over demand and under supply, although that's probably part of it. There's more and more people after COVID don't feel like working anymore. They found out how to game the system, or they're day trading now and making a killing in the market or something. I don't know what they're doing, but less people are busy out there competing for jobs and competing for at least a self-employment job, especially those things that have to do with, I know I'm finding with construction and different things, it's hard to find good help. I don't know what the future holds long-term, but I know short-term we're dealing with this Middle East crisis, high oil prices, and inflation pressures. So the good thing about inflation is interest rates typically stay higher. We're not going to have a Fed decrease for retirees. For our clientele, most of our clients don't want debt anymore unless they've been in a situation where they've had to, maybe remortgage or refinance their house, and they've got a HELOC, a home equity line of credit, that could actually go up in price or up in interest rates if that's the case. But by and large, most people are trying to get out of debt. They paid it down. They're in a position to save a ton of money because they have no debt anymore. And if they can save with higher interest rates, then right now they can keep up with inflation. But I don't know how long-term that's going to play out, because sometimes when inflation happens, the inflation kind of makes those prices stick up there where they end up. But as interest rates go down in the future, and I think they will eventually, then savings isn't going to pay as much. So you're going to have these prices that right now we can keep up with based on the fact that we can invest our money at a high rate. But in the future, if we can't invest our money at a high rate, the prices that are going up now are going to stay up and probably not go back down. That would be deflation. We don't have periods of that very often. We have stagflation, where the economy really doesn't grow, but prices go up and nothing really happens. And that's frustrating because it's kind of a dead economy and just makes everything more expensive. So we burn through more of our cash reserves. But again, that goes back to why we plan the way we do. We know times like this are going to happen over the course of 3 or 4 decades that some people retire. There's a lot of things going to happen. We're going to have recessions. We're going to have monetary policy change. We're going to have different people in the White House that have different ideas about how you should live and how much taxes you pay and where they should spend that money on, and whether they lower interest rates, raise interest rates, make it a climate where you can thrive, or whether you have to just kind of sit back and play defense for a while. But the fact is we're going to be going through cycles, whether it's economic cycles, politically driven economic cycles, geopolitical wars, economies of other countries, good things, bad things, all kinds of things are going to happen. And we've got to position ourselves so that when the good things happen, we're maybe saving a little extra. Maybe we're preparing for those times when things aren't as good so that we kind of ride the wave. We can ride that out a little bit more efficiently. Even though we know the market can average 10 or 20%, especially lately, we're not going to use a run rate of you can continue to make that on your investment money so you can live on X. We're going to pretend it's going to average 5 or 6% because sometimes we're going to make the 10 or 20s. But if we have a correction, we've got to live through that. We've got to wait it out, or we've got to live on other assets. So diversifying your assets into different money classes or money buckets or different types of money. There's the money that you use that's principal protected for income. And there's the money you use for growth that should be money that you shouldn't worry about or let make you sick when really weird things happen. You should get excited when the market does really well. And if you've been fortunate enough to make a big chunk of profits over the last few years, maybe it's time to take some of that profit off the table so that you'll have it next time the market corrects, so that if inflation is still up and you have to spend a little extra money on the cost of living and the things you want to do, or you want to keep traveling and you like the first class seats instead of the back seats. If you want to continue to maintain that lifestyle, it might be incumbent on you to save some money to take advantage of taking some of the profits off the table when the times are good. And we've had some good times. So you never get hurt taking a profit. You never get hurt being prepared, if you're prepared for the right things the right way. And certainly you get hurt less and you have a better sense of confidence if you have a plan. And if you have a plan that you can see the future based on what's happening today, what's happening on your value money with reasonable assumptions of where I'm going to be 10 or 20 years down the road. So if things happen, we can kind of forecast how much of an impact those things that happen have on your future spending, budgets, spending plans, your tax planning and things like that. So if we keep all that in mind and keep track of it and review it year by year, make those tweaks that need to be made, then you shouldn't really be listening to the news and worrying. You should be listening to the news and going like, oh yeah, we got already prepared for that. Oh, we're going to get through this. Okay, no big deal. Hey, let's go play golf and go have some fun tomorrow because we don't need to worry about our money. We've already got it set up to where we've got our income coming. We're paying the least amount of taxes that we have to based on our plan. If the market crashes, it's only going to affect money we don't need to use on a monthly basis. Or maybe we don't have any money in the market at all that we care to lose because we just don't feel like taking risk anymore. That doesn't matter. There's ways to continue to keep up with inflation with interest-bearing accounts, income-generating assets that don't have anything to do with risk in the markets as well. So again, it depends on your blend, your risk tolerance, your stomach, what your goals are, how affluent you are, what your position is going into retirement as to the confidence or level of confidence that you should have with a plan getting through those retirement years.
Jeff, for someone listening right now to this program, it sounds a bit complicated. What should they do next?
If you haven't really had a plan that speaks to more than a year out, you should get one. Find out where your money is. Find out where your income's going to come from, how you're going to reduce taxes as you maneuver those assets around into the different buckets you need. The main thing is, how do you protect your life's work? What you've built a lifetime, how is that going to serve you through the second half of your life, which is typically that downhill run? Shouldn't say downhill as a bad thing. It should be easy. It should be like going downhill. It should be easier than going up. Sometimes it isn't. But if you don't have a plan, it's going to be hard. If you have a plan, it'll be easy.
Talking with Jeff Vogan on Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Inflation is quietly cutting your retirement paycheck. Interest rates are not coming down. And if you're pulling money from the wrong place, you could be paying thousands more in taxes every year. Most people do not have a retirement plan. They just have accounts. So if you'd like a retirement plan, call Premier Retirement right now for your complimentary retirement playbook at 520-780-9059. It's 520-780-9059. Absolutely no cost, no obligation. Get your Premier Retirement Playbook right now, 520-780-9059. You can also find out more about us online at primret.com. Jeff, time for a break here on Premier Retirement. When we come back, we're going to be answering listener questions. And finally, what the first meeting here at Premier Retirement looks like when our program continues on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
We really appreciate you joining us each and every week for Premier Retirement here on 790 KNST. By the way, we're on the air for you 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m. Also Sundays at 11 a.m. If those times are not convenient for you, we're also a podcast. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. Our phone number 520-780-9059. If you would like to get your no-cost, no-obligation retirement roadmap, absolutely complimentary. It's not going to cost you a dime. Once again, it's 520-780-9059. And again, it's just a casual conversation with Jeff to see where you stand in your journey towards a confident retirement. Okay, Jeff, time for listener questions. Mike says, "Hi, Jeff. I love the show. I'm age 60 and my wife is 55, and we're going to retire in 2 years. I have money in my 401k and my wife in her 457B. Total, we have about $2 million. Should we be saving at different places? And what do I do with my wife's 457 and my 401k when I retire? Do I keep them there or do I move them?"
Well, I mean, depends on how they're split. If they're like $1 million and $1 million, then you're 59 and a half or older, so you're 60. So you have no problem. There's no penalties for you taking money out of your 401k and using it. There isn't a problem with the 457B for age 55 if you keep it a 457B. So if you're planning on tapping that money for income, your wife's money, then you probably want to leave it there. If you were under 59 and a half, you'd probably want to leave your 401k intact, at least a certain amount to live on until you get to that age where you can start redirecting those funds. In my opinion, there's nothing in a 457B, even though they called it a 457, a tax is basically deferred comp. It's kind of like an IRA, but you probably have a certain platform of funds and things that you have to use through that 457. The 401k, same thing. There's typically more layers of fees than you would think in them. And they also typically give you kind of the dregs of, like if you have a 457B at Nationwide, they don't necessarily give you the top funds to invest in. You can get those maybe on more of a retail basis sometimes. I'm not just picking on Nationwide or MFS or wherever the 457 might be, but just typically is they've limited the platform that they offer you in those programs. So you don't have as much option. Now, if you're not very savvy and you really hate the idea of using an advisor who could probably do a lot better for you than you could do on your own, but you just hate the idea of you not doing it yourself, then do it yourself. Keep in the 401k, use those limited structured situations and keep it there if you want to. My opinion would be that mistake because you can do so much better. And most advisors, especially us, I'm not a little bit biased, am I? But I am. We could do a lot better as far as structuring that asset into annuities that can generate income, being more aggressive with the aggressive stuff than probably a typical retirement fund 2030 or something like that so many people are just parking their money in. That's really kind of watered down and very much underperforms the overall plans that we would put together for you. The other thing is there's really no tax planning here. You know, as the $2 million comes out, the more you take out, the more taxes you pay. If you are already pretty much tax savvy, then do it yourself. But I figure you're calling the radio station because you're looking for a little bit of help. Like most people, we could probably structure that $2 million out to be, I don't know, probably well over $100,000, maybe $150,000 a year income if you didn't mind spending most of it and still having a big chunk in order to leave your heirs or leave for rainy days if you wanted to. And that would be structuring a plan. It would incorporate when to use your Social Security, assuming you're still going to get that. I'm guessing you still do with 457 and 401. Typically, they're not exempt from that. I'm also thinking 457Bs are typically in careers where you have a pension, so there might be a pension involved as well. But I think that if you're going to retire in 2 years, you ought to just kind of look at all the options for your pension, the options of when to take Social Security, the options on how much of your 401k and 457 money that you can spend and pay taxes on it while you're getting to pension time, getting to Social Security time, so that you don't just defer and kick that tax can down the road, because $2 million in 10 years could be $4 million, and you're still not even old enough to have to take money out. So let's just say if you didn't spend any of it and it was worth $5 million, you'd end up being $200,000 or $300,000 in income you'd have to pay tax on every year, which would be great, but you'd probably end up starving yourself to get there. And then you just only do that in order to be in a higher tax bracket when you're probably not going to use the money in your 70s or 80s. So again, you have the go-go years. It's probably plenty okay to start spending some of that money and paying taxes if you can keep yourself in a, let's say, a 12% or what used to be the 15% tax bracket and not go into the 20s or 30s. However, it might be smart to, over the next few years, as soon as you retire, maybe the few years into retirement, you have an aggressive tax plan where you convert your IRA money, your 457s and 401ks into a Roth, or that way you get tax-free income for the rest of your life. Now, you might want to have other assets, and you would need other assets, in my opinion, to pay the taxes. But there's another option that's kind of a way to pay taxes within its own account, and that is a LIRP, like a Roth on steroids. I've talked about it many times, but the life insurance retirement plan will probably generate more income with less risk than a Roth would. In a Roth, you put the money in, you can take it out tax-free, but when you take it out, it's out. You've spent it. On a LIRP, it's a life insurance retirement plan where you actually buy a death benefit that's tax-free. You borrow against that death benefit while you're alive, but the money that you've put into that account continues to grow on a tax-efficient basis as long as you live. So you have some advantages to do that. And the other thing is you can actually borrow the tax money on those conversions out of the LIRP itself without actually removing the money, so that the money will continue to have a chance to compound and be a lot more efficient in converting those IRAs to a LIRP rather than to a Roth, which with the tax bill having to be deducted directly from it. I don't know if I made sense right there, but I probably used a 1-hour appointment and tried to explain it in a minute. Bottom line is you've got a nice little nest egg, and it'll create probably a nice income stream if you structure it for income. But if you just leave it there, you're going to be limited. You're probably only going to be allowed to invest in risky investments or lower safe investments that perform much lower than the index annuities, index universal lives, and the things that we use that are leveraged to pay more interest and be just as safe as a money market account or a CD. So I would consider options. I would kick some tires, talk to a few different financial advisors. We'd love to be your last stop, because I think when you see our plan, you'll find out it does a lot better when it comes to tax planning, income planning, and just a peace of mind planning than most of our competitors and most of the people that are in this business just touting the same strategy that got you to retirement. And that is just kind of a Wall Street model where you pay fees for the rest of your life and you have to hold it and hope the market does okay. And if it does bad, it's the market's fault. And oh, well, you can't control the market. Just hang in there and it'll come back. And that's really all most plans offer. Well, we can offer a paycheck, a guaranteed paycheck for life, predictable paychecks, predictable tax brackets, and planning that will help you wake up a lot more peaceful every day, a lot more confident every day that you're going to get through retirement regardless of what happens.
Mike, thanks for listening to us in Oro Valley. And again, if you'd like to further the conversation with Jeff, the number 520-780-9059. Steve's in Tucson. Steve says, I'm a longtime listener while dog walking, and I've learned so much to help my financial planning. I retired in 2021, and I've been doing Roth conversions every year. I always do the conversions in December to get the best estimate of modified adjusted gross income so I can avoid the IRMAA surcharge on Medicare premiums. Unfortunately, I've guessed wrong more years than not, usually by only a few $1,000s. I don't feel like I'm trying to cut it too close, but I keep getting on the wrong side of it and having IRMAA kick in. Can you offer some advice on how to maximize Roth conversions and stay safe from dear old IRMAA?
Here's one piece of advice you might want to consider, and that is if you keep on kicking yourself into IRMAA, but you're just barely in there, maybe on the first level, what if you just, instead of maximizing your 22 bracket and just hitting the first level of IRMAA, what if you maximize your 24 bracket, hit 3 levels of IRMAA, but got your Roth conversions done in 2 years? Then you're done. You don't have to worry about IRMAA ever again. Know you're going to go into IRMAA, know exactly what you're doing, pay the extra IRMAA surcharge, but have more money put into Roth IRA accounts earlier so that you get that increase in compounded tax-free gains on that IRA, which in a matter of a few years, probably 6 or 8 years, will more than make up the extra taxes you pay and the extra IRMAA you pay, probably even less money. Sometimes the break even is a lot sooner than you think, but you don't typically have to live to 100 to make it work out. We run our plans to 100 so we can see how much extra you save by living a long time when you do that front-end loaded tax plan. As far as just keeping on the wrong side of it, it just seems like you're just off in your calculations by a few $1,000s. So maybe if it's pretty consistent that you're always off by $5,000, maybe you just make sure you cut it by, let's say, $6,000 next year and see if you make it that time. A few $1,000s is not a life-changing event if you don't convert it to a Roth. But yeah, that extra IRMAA surcharge for the next couple of years at an extra couple thousand a year for each person is a lot of difference, a lot more than the taxes you would pay or the money that you would save if you just didn't convert $5,000 or $10,000 of your Roth this year and just waited to next year or took 1 extra year to do the Roth conversions you're planning on doing. There's also a really fine-tuned program my son got a hold of. He's the accountant, but I'm pretty good at numbers and finds out when the CPA in the firm, Taylor, jumps in and tries to prove the numbers. I'm usually not off by a whole lot, but as you know, by being off by just a little can still be problematic sometimes. So he has acquired for our firm some really good software that will get right down to hundreds of thousands of iterations on when you convert your Roth money and how much you convert. And it will tell you to the dime how much to convert when to convert, and what the best strategy would be. It might also be smart, if you think the market's going to go up this year, to do the bulk of your conversion in January, not wait till December. Because if you have a good year and your $1 million portfolio grows to $1.2 million and you're only going to be able to move $100,000 per year out of your Roth for the next 10 years, guess what? Now it's going to take you 11 more after the 100,000 you just moved this year because you made some money. What if you move that $100,000 out earlier and then you made those gains? Some of those gains, at least 10% of those gains, would have been made in the Roth, not in the standard IRA. And at the end of the year, then you just fine tune it with the extra maybe 10 or 20,000 that you need to get yourself right up against that next IRMAA level and right up against that next tax bracket to try to maximize the conversion and the tax plan over the next several years. So going at it 1 year by 1 year might not be your best bet. It might be smarter to just look at a 10-year or 20-year plan and find out that it might be smarter to just crank out those Roth conversions in the next 3 or 4 years rather than try to make it over the next 7 to 10 or whatever it is that you're trying to do. So again, we've got some software that'll back up our assumptions, and our knowledge over the last 40 years is pretty accurate, but we can get it down right to the penny if you want to focus that close. And if you want us to help you, be happy to have you come by and let us use those programs and tweak your plan a little bit so you don't go to that dear old IRMAA, like you said.
Steve, good question. Thanks for listening to us in Tucson. And again, if you'd like to drop by and talk to Jeff, call ahead. 520-780-9059 is the number. You can make that call right now if you'd like. Leave your name, telephone number, and Shelley will call you back and set up that appointment. Once again, it's 520-780-9059. Next question is Adam in Vail. And Adam says, hey, Jeff, one topic I'd like to hear more about is how pre-retirees might plan to position retirement assets as they approach the last 5 years or so before retirement, so as to provide principal protection for their income floor to minimize sequence of return risk. How should one start? Would moving more risky assets into safer assets be prudent gradually from 5 years out? I'm 8 years from retirement, so this is something that I'm trying to be thoughtful about. Any wisdom from you on this approach would be welcome.
Well, if you dollar cost average out of the market over the next 5 years, you might be locking in losses if the market is at a top right now and starts going out. In my opinion, you never get hurt taking a profit. So you might want to consider this. Let's just say, and I'm just going to use a round number, $1 million. I mean, if you're listening, you have 500,000, you have 500 million, just add a zero, take off a zero, divide by 2. But let's just say you have $1 million and it's done really well. Maybe in the last 5 years, you've gone from 500,000 to $1 million because you've maximized your 401k contributions. The market's done really well. And you're going like, well, if the market could correct and we could go right back to 500,000 by the time I retire in the next 5 years. Well, why not take most of that $1 million off the table for the next 5 years, be real aggressive as you dollar cost average back into the market? That would give you, and $1 million, let's just say you're 60 right now and you want to retire in 8 years. So let's say you're 59 and a half, 60. You have that $1 million 401k. Let's say you took, and we'll just use the round number. Let's say you took $1 million out. Maybe you have a little bit more net in there, but let's say you take $1 million out. You could set that up in an account that would give you, for credit in the future, a 30% bonus if you used it for income later, and it would grow by 9.5% per year. That's the one that we like the most. And I won't say names or product because it sounds like a recommendation, but there's one that I purchased myself. My clients like it, and it probably gives you the best guaranteed income for the future. It'll probably be close to, I'm guessing, somewhere between $70,000 and $100,000 a year, depending on your age and depending on whether or not you use a single life payout or a joint life payout if you're married. So maybe you do that. By the way, the 4% rule says that if you have $1 million, you should only take 40,000 out a year. But if we can get you, let's say 80 or 90, that's double that with the same amount of money. And if for some reason the market corrected and it went down to, let's say, $500,000 in the next 5 years, what then? Now you only got 20. Well, what if you could guarantee that in 5 years or 6 years or 8 years, you have somewhere between, if it's 5 years, it's probably going to be somewhere in the 75,000 range. If it's 8 years, you're probably going to get around 100. So 10 times what you put in is guaranteed income for the rest of your life, plus your Social Security. You've got about $150,000 to live. And then what if you dollar cost average into the stock market the next 8 years and you put your 30,000-ish plus a match into that account? Well, that's going to give you about 300,000 plus growth. And if the market even bounces around, you've still got somewhere between, I would say, $300,000 and $500,000 in total liquid cash that you can move to an IRA that you can continue to take out when you need it, or you could take that money and convert to a LERP and get another $30,000 or $40,000 a year in income for retirement. That's tax-free. I wouldn't load up so much on income once you get to that income level that you like. And by the way, the annuity I talked about that you could set aside funds for and have income in 8 years, depending on your tax situation and depending on what your income is at this point, you might want to consider doing a laddered structure where you convert that money that you convert over to IRA. You convert it maybe for the next 5 years, maybe a fifth of it every year, into a Roth so that when the time comes, you get tax-free income for the rest of your life. How would you like that? You would just have to decide to pay taxes on a few extra taxes, maybe $20,000 to $25,000 a year while you're doing the conversions, depending on how aggressive, maybe 30 or 40. But bottom line is you could be done paying taxes and have tax-free income and maybe be off the government's radar for any taxes, Social Security hits, IRMAA, like we talked about in the last question, et cetera. You could live like a king and pay taxes like a pauper. And that's what our goal would be. So again, look at more than just, hey, should I take some of the profits? Yeah, you should take some of the profits. When the market's high, you should say, hey, how much could what I've saved buy me? Whether it's all of it or a piece of it or a chunk of it. If you've got 8 years to dollar cost average back in the market, and especially if you're in your highest earning years, you should be able to make up a big chunk of that difference of what you've already made and take those profits off the table and make a nice little nest egg in addition to that by the time you retire. So again, you never get hurt taking profits. It's prudent to lock in income. And if you can use some of the guarantees that are available right now, while interest rates are the highest they've been in a long, long time, the companies that offer the basically personal pension payout programs that are guaranteed, secured by more insurance than, in my opinion, than a bank, although banks would say, oh, nothing's better than FDIC, which, by the way, is broke. I started a bank. I know what FDIC has in it and how it works. It's not that big of a deal. But insurance companies that offer basically your own personal pensions have to have your assets, plus a surplus, plus legal reserves, plus a lot of security, and in addition, insurance programs that back that up, even if they were to get in trouble. So you got some real secure options if you want to try to get tax efficient income, or at least a plan where you know what your income is going to be, what your taxes are going to be, whether or not you keep in or out of an IRMAA, the dear old IRMAA levels or not, and go from there. But I think now is a great time to plan. I'm happy that you're calling in early. So many people wait till they're 5 months out, not 5 years out or 8 years out. So good for you for checking in sooner. You're going to be so much better off starting to plan now than you would have been if you'd have waited and rode through a couple market crashes, got nervous, and found out you couldn't retire in 7 or 8 years, but it might have taken 10 before you got back on your feet and to that point where you could retire. But you can lock that retirement plan in now if you make the right decisions early rather than wait till you have to react to whatever the market gives you.
Adam, great question. Thanks for listening to us in Vail. And again, if you'd like to further the conversation with Jeff, 520-780-9059. If you've got a question you'd like us to answer on the air, you can get it to us 2 ways. One of which is you can call it into Shelley, 520-780-9059. She'll take it down and pass it on to us. Or you can go to the website, premret.com, and use the contact page there. We use it on the air. You'll get a great answer to your question. Again, 520-780-9059. That's the same number you can use for your Premier Retirement Roadmap. Absolutely no cost and no obligation. Jeff, I want to round out the show today by talking about a question that a lot of people have for us here. What does this first meeting with Jeff look like, this Premier Retirement Roadmap? People a lot of times, I think, are hesitant because they fear that they're going to be sold something. That's not what happens in the first meeting. Tell us a little bit more about what this first meeting or this initial consultation actually looks like.
Well, first of all, it comes with no judgment. I don't care if you have $100 or $100 million, you're still a person with a nest egg, and you need to be respected for what you've done and given frank advice for where you can go. So it's probably incumbent on the person coming in to not feel like they're getting judged or sized up or anything. I mean, we have such a wide range of different clientele that we've served here over the years and that we serve on a regular basis. Typically, we serve the people that have tax problems because that's really our focus, and people that have, amassed a decent level of affluence where we know that they're probably okay. But we want to make sure that they don't overpay taxes. We want to make sure that they don't lose their life work. Our total goal is to put them in a place where they feel better having come in here. So it's going to be a pleasant conversation. The first visit is never about selling you our services. It's about finding out about whether or not you even want the kind of stuff that we provide, or even if you have a situation where we can make your life better. There have been people that have done so many things and have kicked the tires and done so much research that they found a lot of solutions to a lot of problems. And they're actually in such a good position that there's really not an incremental level, although I'd love to have their business and have a new client. But in some cases, they're already okay and they have a good relationship with their advisor. They just want to double check, and we'll let them know that they're in good hands. However, there are people that we can see that there are holes and there are gaps in their plan that we know we can make better. Sometimes it's for those accounts that aren't that big because they've never been actually in a position to receive the kind of help that would get them to the next level, to get them from a good position to a great position. And we try to make that happen. So I get excited to see a plan where I can see somebody's situation, and if they continue to follow it, they're going to live on X amount of dollars, they're going to pay X amount in taxes, and they're going to give X amount to their heirs. Based on that same exact return and based on creative planning, I love a plan where we can say, hey, by doing this, you're going to save $500,000 in taxes, you're going to spend $1 million more in net income, and you're going to give your kids another $700,000 in net asset value based on the same exact returns, just by moving your money around in different buckets and protecting income, protecting yourself against the downturns, not locking in losses when the market's choppy or volatile, and by saving taxes. Those taxes you save result in the effective compounded returns to you and the income that you get to spend or the income that you get to pass on to your heirs. So when I see somebody come in and we can make their life $1.5 million better, I get pretty excited about that. And sometimes I get enthusiastic. I actually had a lady tell me, I don't know if I should do business. You scare me. I said, I scare you. Why? She says, you're way too enthusiastic. And I go like, I'm showing you how to save you $1 million in taxes and assets that you could give to your heirs and leave in your family. He's like, yeah, I'm excited. You're going to keep that money here in Tucson, in my community, where you make our world a better place, your family's world a better place, instead of throwing it in that black hole in Washington, let them throw it away. I said, so yeah, I'm enthusiastic. Why wouldn't I be enthusiastic? I do like that kind of a plan. But there's some times when people come in and incrementally, we can do Roth conversions and kick them into a higher tax bracket, just to have them in a lower tax bracket later. And they might have been in a low tax bracket in the first place, or never been in a position where they could actually get their tax bracket. You might have so many assets, they are never going to be in a low tax bracket. And so sometimes some of these aggressive tax plans aren't going to help them incrementally enough, but we like to show that. And in order to do that, the first visit is to get to know you. Hey, what are your problems? What are your pain points? How can what we do help you? And then if we like each other after the first hour or so together, then we'll build a plan for you. We don't mind building a plan. We ask that you don't go giving it to all the other people that don't do plans and show them how we work, but we'll give that to you. We'll let you look it over. We'll let you ask all the questions, highlight it up. Basically, we get to take the cover of the box of the puzzle off and you get to see the pieces inside. We show that to you. We show that these are the tools that we use. Do you like them? Go home, read about them, study them, come back and hit us up with as many questions as you want. So the process is typically at least a 3-visit process. The first visit, get to know you. Second visit is to show us how we've made happy clients in your similar situation happy and save them taxes and created an income stream for them that they can count on and put them in a better place. And as soon as we get to that better place, then you decide whether or not you want to move forward or not. So you can actually get to that better place, not just see it on paper. And that process is pretty easy. We just gather some information. You turn it over to us. As soon as you authorize us to be your agent or your representative as a registered investment advisor, we can go out and gather those accounts for you with your permission and put them in Fidelity or wherever we hold them and move them to the accounts that you authorize us to do on the plan. So you really just have to understand where we're going. We want you to understand what the plan is before we jump forward. I had some guys that were trying to actually provide some new clients and leads, and they had this training program. I was trying to get my kids set up with some programs to where they could help enhance their chances to meet new clients. And they're saying, well, you don't want to tell them what the plan is. You just tell them you can help them, and you just tell them how awful their plan is so they feel the pain. And then when they move it, then you show them the plan. Mm-hmm. Like, how would anybody do that? We show you the plan. We want you to be comfortable with the plan and be on board with it before we start doing paperwork. So again, you don't need to come and be afraid. We're not going to try to close you. I hate that word, close. We're going to try to explain to you the reality of your situation. We're going to show it to you on paper, what will probably happen tax-wise, even if things don't change or if they do change. We're going to use similar assumptions on your situation now as to what we propose on our situation, even though, in our opinion, we can do a lot better with returns on your managed investments and returns on your safe investments. But we're not going to even incorporate those without incorporating the better returns and the better performance. We're going to show you just on how allocating your assets into the right buckets, saving taxes, and having a plan based on how you position your assets and how you take that money out of those assets, that will make sense. And if that makes sense, we'll move forward. And I think what you'll see is that we've under-promised and we'll end up overperforming more times than not.
Great conversation, Jeff. Let me talk to our listeners here for just a moment. If you built real wealth, but you're not completely sure how it's all going to work together, you're not alone. This isn't about starting over. It's about getting a second set of eyes on everything that you've built. Jeff Vogan and the team here at Premier Retirement Planning are offering you a complimentary Premier Retirement Roadmap. If you would like this, call 520-780-9059. It's 520-780-9059. You can also find out more about the firm online and request your roadmap at premret.com, PREMRET.com. Well, Jeff, we've had a great show, but it's time for us to get out of here. So for Jeff Vogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.